Hey, this is Beatrix Whipple with the Whipple Group, and today I'm here with Jason Thomas from JMJ Financial, and we're digging into all of the changes coming down the pipeline with the condo market and financing for condos. Earlier, I did a video talking about all of the different things that buyers need to look out for when they're looking at condo docs, what makes condos unfinanceable. And this year, there's a lot of changes coming down the pipeline that's going to affect any buyer looking at a condo in California.
Yeah, thanks for having me, Beatrix. Yeah, there's definitely a lot of changes that are happening later this year. There's already been some that were being put in place in the last year or two as well. And essentially, it's turning a condo purchase into not just underwriting a buyer, but kind of just underwriting the HOA as well. And that needs to be taken into account if you're looking into buying a condo.
So I know there are certain guidelines that have been in place for years, guidelines that touch on how many owners versus renters, how many of the owners are delinquent on their HOA dues, what the reserves look like, how much of the budget is being allocated to the reserves. What are some of the new guidelines that are coming down the pipeline?
Yeah, well, for starters, one of the positives, especially for associations that are investor heavy, is the 50% concentration rule. And by that, I mean needing at least 50% of them being primary residents, right? That's going away.
Okay.
So it's going to be easier to get conventional financing for those associations that have a lot of investor loans in them, right? So that's a good thing. But as far as everything else, it is getting a little bit more strict. Reserves, minimum reserve requirements are going up. Currently it's 10% of the budget should be allocated for reserves, and that's being bumped up to a minimum of 15%. And then also the limited review, and by limited review, that means that in certain instances on conventional financing, you don't need to get every last document from the HOA and review everything with their financials going on. That limited review is going away.
What a lot of buyers may not know is when you're buying a condo, the lender is not only underwriting the buyer, they're also essentially underwriting the association and making sure that the association is in good financial standing. And part of that review is there's a document called a condo cert where the lender will send a document to the HOA and they fill out various different questions. And typically, am I right? The more down payment you have, the shorter that review is. There's a full review and a limited review. Is that right?
Yeah, and oftentimes 10% or more would allow for the limited review. Anything less than that, generally, you're going to have to do a full review unless the association was already approved. Then you may not have to really do anything, right? So that made things really easy. But between, and that's just a waiver, right? Between waivers and limited reviews, there's not actual data as far as a percentage, but it was close to 50%. So there's quite a bit that's going to be eliminated now and require a full review moving forward.
So there's no more limited review. There will only be the full review on condos.
Full review, or there's still the waiver potentially.
Okay.
How the waiver works is if there's been another lender that submitted a loan within usually the last 6 to 12 months and had to do the full review, and the HOA supplied all the documents and they met all the requirements from Fannie Mae, that loan was pushed through. It goes on, and it's basically just data on Fannie Mae's database, right? And other lenders can see like, oh, this was recently done, let's say in the last 3 months, 6 months. It's not technically like an approval list. It's just, hey, we know that these documents from the HOA are good and they're going to be accepted. And then you can get a waiver and not have to go through that whole process again because another lender just did it a few months ago.
Got it.
Yeah, it usually lasts, like I said, anywhere from 6 to 12 months. That's why when like lenders like myself, we run it through Fannie Mae's system, the association, and they'll give us an expiration date. And that expiration date is just based on when the last full review was done.
So limited review is going away, full review will be in force, and there will still be exceptions for a waiver if there was a recent approval on a full review.
Right.
Okay.
Yep.
When is all this coming down the pipeline?
Yeah, it's in August is when the some of the changes are happening. Another one's happening just at the beginning of next year. When it comes to the reserve requirements for the budget. The other big one, aside from the reserve requirements, is the reserve study, which is different from just
Yeah.
the reserves, right? So basically, if you have an association and they are, well, currently it's a 10% requirement, right? If they're not funding at least 10%, it's a bit of a red flag. And then the lender's going to want to dive in more and look at the reserve study, right? If the reserve study is recommending something much higher, just based on whatever deferred maintenance or whatever is going on in the association, like let's say the reserve study is requiring 18% or recommending
Hmm.
18%, instead of just going off of the baseline, like Fannie Mae used to, which is currently 10%, they're going to require the 18%. Otherwise, they're going to deem the association as underfunded, and they're going to want to look into it more. If like an association is funding, let's say 8%, and the reserve study recommends 18, that one's probably going to get denied now.
Okay, this is really interesting. So I'll kind of touch on what a reserve study is, because a lot of people watching this may not know. The HOA hires a third party company to come in and evaluate all of the elements of the building that have a lifespan, basically.
Mhm.
This is my question. It will determine how long the useful life of those particular elements are, or do they take an average of, for example, let's say, okay, if there's an elevator, the typical lifespan of it is X amount of years, so that the useful life of the elevator in this particular building has X amount of life left in it. Do they actually evaluate on a case by case basis, or they apply kind of blanket expectations of lifespan?
No, they evaluate everything. Yeah, and so just because, let's say, the entirety of everything to replace, let's say that was $1 million,
Hmm.
but when you add everything up through the useful life, let's say everything on average has like a 50%, and I'm saying, some things might have 70% left, some 30, but if the all told, is at 50% and they're recommending that they should be funded at $500,000, if the HOA currently does have that set aside in reserves, then they're fully funded,
Got it.
right? They don't need to be at the million because there's still the useful life left over,
Hmm.
right? But if they're only funded at, let's say, 100,000, then they're at 20% of where they should be. That doesn't look good,
Yeah.
right? And that's probably not going to get pushed through.
Now, most of the reserve studies that I've seen, and not every condo has a reserve study, a lot of HOAs don't have them. Is it going to be a requirement moving forward that condos have reserve studies?
If they're not funding at the new baseline amount, which is now going to 15%,
Hmm.
then yes, they're going to be requiring that.
Okay.
Yeah.
When I evaluate HOA docs, because whenever I have a buyer buying in a condo, I look at everything. And if they have a reserve study, I look at what percentage funded they are. And I've rarely seen anything above 70%. What I tend to see, at least here in Long Beach, I see a lot of 30%. Is that kind of the threshold that you've been seeing, or do you see it all over the board?
Yeah, it depends. I mean, most of them are going to be on the lower end. I
Mhm.
mean, 70% would be a really well-funded, well-managed HOA, and that costs a lot of money to do so, right? Whether that's through increasing HOA dues or special assessments or whatever that looks like. And that's something that we can touch on as well moving forward because they're requiring more now, is how are these HOAs going to meet these requirements? And are they going to have to just levy special assessments on all the homeowners, whether that's in lump sums or greatly increase HOA dues? I don't know. It'll be interesting to see what happens with all of that. But 30% that's kind of like the bottom of the threshold, and I think moving forward, depending on what all these other things look like with the HOA, anything less than that is going to be really difficult, I think, to push through because
Yeah.
it's going to be hard to justify that this association's financials are healthy.
Hmm. And that's coming down the pipeline the beginning of next year.
Beginning of next year, yeah.
Okay.
Hmm.
So we've talked about the allocation of funds to the reserves moving from 10% as a requirement up to 15. The threshold or the ratio of reserves as compared to what the reserve study is suggesting. What other changes are coming down the pipeline?
Well,
Oh,
the other
yes,
thing is
sir.
the reserve
Yeah.
study,
Okay.
where instead of going off of Fannie Mae's baseline, which was 10%, is now going to 15, they're
Mhm.
going to go off of whatever the highest recommended is from the reserve study. So if that percentage is higher than what Fannie's baseline is, they used to just go off of the baseline.
Okay.
They'd go off of lesser, but now they're going to go off of the higher. So it'll just depend on each individual
Whichever
reserve
is
study.
higher.
Mhm.
Okay, so this is gonna be huge for the condo market, and this is all over California, or is it nationwide?
Nationwide.
Okay, this is going to affect condo financeability probably more than anything else we've seen coming out, right?
Yeah, I mean, if we're just speaking about California, specifically, of course, SB 326
Oh, yeah.
is a big issue.
Yeah.
So for our marketplace, that one you got to lump that in there. It's making things a lot more difficult
Yeah.
for condos. It'll be really interesting to see how how things shake out. I think it's going to take probably at least, God, I don't know, at least a few years probably for this to sort itself out. But there's going to be a lot of associations, at least initially, I think here, that are going to be non-warrantable.
For sure. For
Yeah,
sure. The balcony inspection, SB
326. Yep.
326. I have a whole video coming out on that because that deserves a video in it of itself. But that's a deal that we first connected on
Hmm.
when it came out of left field and we had no idea. I had no idea what was going on. And a lot of agents still don't entirely grasp what has happened with balcony inspections in California. But it's been a big, thorn in the side of a lot of HOAs and causing financeability issues. Do you want to touch on that briefly? And then I'll go into more detail in a separate video.
Yeah, yeah. SB 326, it's a new balcony law. So all associations as of January 1st of this year were required to have this inspection complete. Otherwise, they're out of compliance with the state, not just for financing, but just with the state in general, right? Through this bill. So, the GSEs, Fannie Mae, Freddie Mac, they have, they've changed their guidelines so that not only does this inspection need to be done, it's part of the lender's cert now. It's a question on there, has there been an inspection done in the last 5 years?
Mhm.
Yes. If there has been, they want to see a copy of that report. And whatever the findings are in that report is going to determine if there's financing that can be done, right? So if they've recommended that there's critical repairs on a few units in the complex and the HOA has not had those repairs completed yet, then it's non-warrantable, essentially, is where we're at now.
And just to educate people watching this who may not understand what non-warrantable means, you can still get a loan,
You can still get a loan,
just not a great loan.
just not a conventional loan.
Yeah.
Non-warrantable just means you can't get conventional
Yeah.
financing.
And
Yeah.
what are some of the pitfalls of non-conventional financing? Higher interest rates?
Higher interest rates, a higher down payment, usually 20%.
Hmm.
Again, higher interest rates, maybe like a half point higher in interest rate, maybe slightly higher fees, reserve requirements, meaning maybe up to 6 months of your monthly payment set aside that you still have in the bank for reserves
Hmm.
beyond all of that, which is really hard to do, I think, for condo
Yeah.
buyers, especially primary residents, because a lot of them are first time home buyers
Hmm.
and they're doing minimum down. They don't have a ton of cash in the bank. So coming up with 20% down, having an extra 6 months of your payment set aside, paying a higher interest rate, all these things, it's a lot more difficult to deal with.
So this, I can only imagine, is going to affect condo values and their appreciation because it makes the pool of buyers so much smaller as these new regulations come into play.
Definitely, yeah, and especially in certain associations as well that are way behind on all of this, way underfunded, not well managed. It could be a really long time before they can do any sort of conventional financing
Wow.
moving forward. It'll really hurt the values of those
Yeah.
places as well. But as a whole, yeah, I mean, it's already, condos already don't appreciate at the same rate necessarily as single family homes, depending on the area. And it's just going to make it, that much more difficult, I think.
Yeah. Condos, I feel,
Yeah.
have taken a beating the past couple years,
Yeah.
and the balcony inspections have only added fuel to that fire. And then now these new regulations coming down the pipeline. I mean, I guess the good news is the good way to look at it, though, is that lenders, they're not only protecting themselves, they're also protecting the buyers from potentially purchasing in an association that isn't solvent, right?
Yeah, that's the whole idea
Yeah.
essentially, right? Yeah, is making sure that these associations are well funded and can
Mhm.
manage if there's anything catastrophic that happens in the complex. That's really what they're looking for is they
Mhm.
want to make sure that the association can take care of any issues moving forward. So when you combine SV 326, whatever's coming up with that, if that's an expensive repair that needs to be done and it's already underfunded,
Mhm.
and now they're changing their guidelines requiring even more funding, it's a double whammy for these associations. It's going to be really hard for them to recover from that unless they're issuing some pretty heavy assessments on the existing homeowners. They're going to have, obviously completely changing how the financials are managed, the budget's managed. It's a lot. Yeah. There's certain associations I think are going to really struggle for a bit trying to sort this out.
And is there any kind of delivery or messenger system, or how do these HOAs find out, other than a real estate agent taking a listing and learning about these obstacles for financeability? Other than that, how do these associations find out? I mean, I assume if they're professionally managed by a property management company, the property management company ideally should be in the loop with all of these new guidelines and adherence to them, being implemented. But if it's a smaller self-managed HOA, how do they find out about this?
Yeah, I mean, that's a great question. I would say,
So we talked about the limited cert going away. We touched on the balcony inspection issues. We talked about the reserve requirements. We talked about the reserve study. Was there something else?
I think that was about it. I mean, the insurance change, there's been some insurance
Oh my
changes that are
gosh.
helping a little bit. I mean, I don't know if you want to call it helping. It's making it easier for on the loan side of things, but it is getting passed off to the buyer essentially.
One thing that I'm seeing throughout a lot of HOAs is insurance companies now are requiring old Zinsco panels to be replaced throughout
Oh
the
yeah.
community. Have you heard
Yeah.
about that?
I
Yeah.
haven't, no.
Yeah.
Yeah.
So I've had a lot of homeowners reach out to me because they were told by their HOA that all of the electrical panels need to be updated. And there's this brand called Zinsco that always gets flagged in a home inspection because I guess some of them were fire hazards. And now insurance is so much stricter here in California. I don't know about the rest of the country, but here in California, that a lot of homeowners insurance companies, they won't insure you if you have that.
Wow.
Yeah.
Wow.
So another headwind, I guess, but it's
Yeah.
it, it's all for the greater good of financial and physical safety. But I think it's a lot to take on all at once, especially if an HOA is already struggling.
It really is. Yeah. It makes you wonder how they're gonna recover from it.
Yeah,
I mean, unless they're just a non-warrantable association. I don't know. I mean, it's gonna take quite some time, I think, for it all to sort itself out.
yeah.
Yeah.
Well, thank you so much for your time,
Of
and
course.
I love how much value you bring whenever we meet with you, and all of this insight that I think a lot of real estate agents don't know and can't plan for and can't prepare their clients for. So I feel like you've really kept us, a few steps ahead. And then also that enables us to be able to inform our clients and the general public about what to look out for and how to maintain their property value, even amongst these headwinds that are coming down the pipeline.
Yeah, well, thank you,
Yeah,
Beatrix. Yeah, I mean, it's important to keep your clients in the loop, obviously, and inform them ahead of time so they can prepare. I mean, I know they're not necessarily fun conversations to have, but it's better than like when it absolutely has to be addressed, right? It's always worse at that point than if you try to get ahead of it, right? Because
hmm
at least, hey, this is what's going on. Here's what we can potentially do
hmm
to help solve the problem, right? Instead of just hoping it goes away, right? Because
yeah,
it's not.
yeah.
Yeah.
You can't just ignore it.
Right.
So I have a buyer guide to what to look out for when they're reviewing their HOA packet. That is going to be linked in this video via QR code and in the description. And I will be coming out with a new update to that I will also link in this video. So you'll see that as well. And one last question that I just thought about. A lot of times buyers don't learn about all of this because the HOA docs aren't ordered. Two questions. This is a two-part question. They're not ordered until they're in escrow. So a lot of times I have buyers say, "Hey, can I review everything in advance of?" And I'll tell them usually not, because it's not even ordered until a buyer's in escrow.
Mhm.
And then they're at the point where they've fallen in love with the property, they're emotionally attached, and then they learn that it's either not financeable or non-warrantable, or it's going to cost them a lot more money than they originally thought. Do you see any regulations coming down the pipeline that may require an owner? And I actually think this would be a really good idea to provide all these docs in advance of an offer being made rather than being reviewed during the due diligence process.
I don't know that it's gonna be a requirement, but I kind of feel like it should be.
Hmm.
It would make it a lot easier up front, like we were just talking about, to know all these things, because that is something that if we did have up front, you could submit that to the buyer's lender
Yeah.
that they're working with, and they can let you know if there's going to be issues or not,
Yeah.
right? I've been requesting that a lot of times, actually, with the SB 326 stuff. Hey, can we get a copy of this report before we get going here? And actually, depending on the HOA, they'll say like, "Oh, we don't need to release that," or they won't even give it to the homeowner.
Oh my gosh.
Or the only thing they'll say is, "We've been advised by, legal counsel that we can only give information for the homeowner's specific unit," and it's just not a thing,
It's going to come
right?
out.
It's gonna come out.
Yeah.
So, while we've tried to get that report up front sometimes, the HOAs, I don't for whatever reason, they're being advised differently, and they won't release it. Some have, and we're able to actually review it ahead of time and
Hmm.
see the issues and, respond accordingly, like, "Oh, this one's for sure gonna be non-warrantable." Well, now at least the realtor and the homeowner know what to expect and know how to market it correctly,
And
right?
I think that's something that I've learned as an agent throughout all this. One of the things I rant about all the time is how unregulated the cost is for HOA doc packages. And what that means is when a condo goes under contract, the seller is required to pay for the homeowners association to issue a doc package that has all of the HOA docs, the rules, the regulations, the bylaws, the budget, the reserves, everything, balcony studies, anything like that. And the amount that these HOA management companies, or even if it's a self-managed HOA, charge, there's zero regulation. I've seen HOA doc packets range from $500 up to $1,800.
Wow. Yeah.
And I always try to anticipate this when I'm working with a seller of a condo, when I put their net sheet together to let them know what they can expect to walk with after all costs and fees at a certain sale price. But there's no way to know how much the HOA is going to charge for this unless you're actually ordering it. And I've talked to a lot of agents and homeowners about this. There has to be some regulation coming down the pipeline. It seems like the Wild West with what HOA companies can charge to email a packet of PDFs, right?
Yeah, it is pretty ridiculous, and it's the same thing on the buyer side, or even if they're doing a refinance, seeing how much it costs to order a copy of the master insurance and, a lender cert, especially if you have to rush it.
Yeah,
And all of a sudden you're $500-600 extra in fees on
yeah.
top of all the other fees just for a refinance. It would be nice if there was a little bit more regulation around that, because it does seem kind of silly how expensive it can get.
It's wild that you have to pay hundreds of dollars extra to have someone email a PDF faster,
Yeah,
right?
exactly.
Yeah,
Yeah, yeah. Instead of it being 10 days, they'll
yeah.
send it to you in 5 days and charge you an extra 3 or
He's not
$400.
exaggerating.
Yeah,
No,
yeah,
it's true.
yeah.
So if you found this useful, reach out. If you have any questions that you'd like us to cover in future videos, I'd love to hear about that. I'm Beatrix Whipple with the Whipple Group. This is Jason Thomas of JMJ Financial. All of our contact info will be in the caption. And I hope you enjoyed this.
Yeah, thanks, Beatrix.
Thanks for your time.
Yep.